All right, and we're on. Okay, so we're gonna go and we're gonna talk about this as if we've never looked at this before. Okay, I need my entire board. Oh, that's because this is too big. No, that's not it. Okay, there we go. Okay. All right. So the purpose of accounting is simply to record the transactions in a business, right? So when you go and you start your business, there's going to be tons of things that happen with money that you have to start recording so that you are aware of how profitable your business is. Okay. So accounting is the method created by someone millions and maybe like hundreds of years ago, probably not millions, hundreds of years ago, in order to make it so that it was streamlined across all businesses. So that when you try to compare one business to the other, it will work. Okay. They will all have the same type of layout. Okay. So in doing so, accounting started off with T tables. Okay. So these T tables were kind of used at the beginning to best explain how to create a journal entry. All right. So with the T tables, they came up with all these different, not characteristics, but naming systems in order to record what those transactions look like. So the basic 6 naming conventions were assets, liabilities, uh, revenue, expenses, capital, and drawing. Okay? So these 6 items will give you a classification. It's the classification name, and everything that happens in accounting is going to go under one of these 6 different naming conventions. Okay. The key for accounting is to be able to recognize what you're doing and which one of these categories does it fit into. So, in chapter 1, we go over, well, what is an asset? So, assets are basically the items owned by the business. In the workbook, let's grab my book. If I go to the back and I look up the definition, is there a glossary? I don't see a glossary. The index, I don't see a glossary. I don't see one. The index. Okay, so no gloss. So let me look in the chapter real quick. All right. So assets are resources a company owns or controls. Yeah. So items, so basically items owned by the business or the business. Okay, liability is value of what the company owes. So in here you're going to have different types of naming, but this is everything that a company owns is going to be sitting in liability. Revenue is the value of items sold or services rendered. Meaning that if we are a merchandising business, it's the value of everything that we sell. And if we are a service business, it's the value of what work we've done for other people. Okay. Expenses is all costs needed to produce a good or render service. So if we're rendering service, one of the main ones is probably like rent expense. So we have a physical building that we pay rent on for our office. The rent expense is an expense. If we have to pay utilities in that building, utilities expense is an expense. Capital is the value of investment by owner. Okay, so it's whatever money the owner put into the business. Okay, drawing is the value of money withdrew by owner, and it has to be by the owner. Okay, so drawing is the value of the money withdrawn out of the business by the actual owner. So then we look at on page I don't see a page where it doesn't. Okay, well, then we have to look at the different types of assets. Okay. So the items owned by the business, and some type of assets are supplies. So supplies is not the value of what we use, it's just the value of what we purchased and we literally have in the building. So these are supplies that have not been used yet. And the reason why I'm going to go ahead and give you supplies expense, because those are two different categories and they mean a different thing.
That's why
Okay.
that right there is like supply asset and no.
Yeah. So supplies is the value of them when you purchase them and they're here.
Right.
Supplies expense is the value of what you use of those supplies.
Okay.
So I think in like chapter 4, we start to adjust supplies based on what we end up having left in the business. So if we originally bought 500 and throughout the month we use $50, the $50 is going to go over here. And then the new balance over here is going to be $450. So we're still going to have $450 supplies, but we're going to have the expense of $50. So that's the supplies and supplies expense.
So what you have versus
What we use, yeah, what we have versus what we use, correct. All right, another asset is the building. Computers. Any other assets you guys can think of? Furniture. Anything else? Yep, we'll put that in supplies, but yep, you're 100% accurate. I was trying to see if land is an asset. We have computers. Yep, we got computers up there. Cash is a big one.
Oh, I got it right here.
Cash. So cash and land. All right. So it's all the physical stuff that the building owns. I mean that the company owns.
All
right?
physical stuff.
Yeah, all the physical stuff that the organization owns. What's not physical is AR, but this is a huge asset. AR is accounts receivable. Okay? So our liabilities is the value of what we owe, what the company owes. So the big one that we use all the time is going to be AP, which is accounts payable. You do need to know the difference between accounts receivable and accounts payable. Okay? So later on, some more significant, not more significant because this is the one we use most often, but some other ones that are going to be included in liability is going to be mortgage payable, we're going to use some supplies, oh, salaries payable. What is some other one? I don't see any other big ones right now. I know that there's oh, we got interest payable. This is all money we owe, right? So we haven't paid our mortgage. Well, even if we have paid our mortgage, typically there's going to be a mortgage payable somewhere on our balance sheet. Because if we got a 30-year mortgage, they're going to split it up between what's long-term and what's short-term. Short-term means that we owe that money within 12 months. Long-term means we owe it outside of 12 months. So let's say we have a $30,000 mortgage. On January the 1st, we might have mortgage payable equal to $12,000 for the year. This is $1,000 a month, right? And then this is going to be short term, or it's going to call, they're going to call it current payables. That's the short term. That's under a year. That's current payables. And then we'll have a long term payable equal to what is that? 18,000. So long term payable of 18,000, and then each month we reduce this by 1,000, and the offset is going to be mortgage expense. Make sense? So when we start doing our T tables for mortgage payable, we want to decrease that every month. The offset is going to be mortgage expense because we paid it. Okay? All right. Okay. Salaries payable. We revisit this again in chapter 4, I think. And the offset for salaries payable is going to be what? Salaries expense. Interest payable also is gonna be interest expense. Make sense? All right. So then, after liabilities, we have our revenue, okay? Our revenue is gonna represent all of the money, the value of money that we've earned in our business for for selling a good or for performing a service. Those are typically the two ways to earn money. So for revenue, we're gonna have service fees is one. What's another one? Fees earned is another. We got rent earned is one. Recognizing the difference between rent payable, which is what we owe for rent. If we haven't paid it, we'll have that. Rent earned is what money we made if we're renting it out to somebody else, right? So this is if we're paying it to someone, this is if we're renting it out to someone else. And then we'll have rent expense. Once we pay, well, you don't have to actually pay the money, but once we incur that expense, we'll have rent expense. This is if we are the renters. We are renters. We are renting. And we are renters. Make sense? If we are a mechanic, we got repair fees earned. Another type of revenue.
If you really like put the amount under, is that like fees earned?
It will be fees earned. You might even break it down to like whatever the professional word for doing hair is, and then whatever the professional word for doing nails. You might have two different types of esthetician or something. You might have like esthetician fees, and then you might have sew-in fees. Like you might want to keep your sew-in separate from like perms, relaxers, dyes. Like if you're a company, you want to see how much am I making from this specific type of services. Yep, we want to break those down so you can see it. So remember, the whole purpose of this is simply to identify where you're spending money and where you're earning money, so you can make a management decision to move forward with something or to stop doing something. Okay?
Yeah, really, it's easier to know specifically which one is a word problem. That's what lets me know.
You have to. This is a good thing to take a picture of once we finish, so you can kind of know what categories these things are in, right? Because once you know the categories, T tables are easy. But if you got the category in the wrong T table, it's gonna mess up your debits and credits.
Right.
Because it won't go. You'll try to figure out why, and like knowing that your debit has to equal your credit. It's just a bunch of like the small rules that you have to have in place in order to kind of move forward. It's not hard. It's just a lot of steps. So you just gotta be comfortable with each one of the steps. So next we have capital. And it's really just, the capital one, just remember, it always has like the person's name. So you'll have, so if it's my company, it'll be LW Capital. If it's owned by John McCain, it'll be John McCain. John McCain Capital. Or Angel Capital.
So you can put anything into your
Business.
Yep. Put a building into your business.
You can put anything you want. You can donate computers, like if I just happen to have 3 computers in my house because I got 2 kids and they fight, and I got my own computer. But I tell them I'm done with y'all. You know, y'all worthless. I'm gonna start this business because I'm gonna make some money. So you take their computers, you put them into your business. Now you have 2 computers that you invested. Take the value of it. Say they were both $500 a piece. You're gonna put $1,000 worth of an asset into the business, and it's gonna be worth $1,000 of capital. So you can't tell right now, but your credit is gonna equal your debit. Because one, and we'll go over it. I'll go ahead and put this up here. We'll talk about it later. All right. Okay. So we'll talk about it later, but you should have 3 plus minuses and 3 minus pluses. And if you've seen any previous lectures, you already know what that means. If you have not, I'm going to address it shortly. I don't know why I pulled up. Okay. All right. So this is all the investments, and this is what they will typically look like. Drawing is the same thing. So it'll say LW withdrawals, or it'll say John McCain withdrawals, or it'll say Angel withdrawals. Okay? Make sense? All right. So these are our categories. Couple of rules that you gotta have. Moving forward. Okay? When we create our T tables, and or our journal entries, your debit must be equal to your credit. Okay? Your debit has to always be equal to your credit. Another rule is your debit is always on the left side of the T table. Your credit is always on the right side of the T table. Right? Plus equals or means increase the account balance. Minus equals decrease account balance. Make sense? Okay. Another rule is on the journal entry, debit goes first. Okay, so I erased the board, and now we're going to start working on our T tables. So we're going to start on page 14 in the book, chapter 1. We have these rules still up here, and I'm going to keep them up there. Okay, so in the past, I had explained that there are 6 categories and 6 T tables that go with these categories, okay? So I have my best way that I use to memorize them because they do need to be memorized. And that's going to be DEA, you know, like the FBI, I think it's the Drug Enforcement Agency. So that tells me all of the ones that are DEAs are plus minuses. When I say plus minus, I mean on the T table it's a plus minus. So the debit is an increase, the credit is a decrease. The second terminology that I use, or the second acronym that I use in order to help me remember which ones are the minus pluses, is CLEAR, CLR, the cleaning solution. And that one is going to be minus plus, meaning the debit is a decrease and the credit is an increase. So let's draw our T tables. We have D for drawing. Drawing, we said, was a plus minus. We have E for expenses. That is a plus minus. We have A for assets. That is a plus minus. Those are our CLRs. Those are our DEAs. Then we have C for capital. This is a minus plus. And we have L for liability. Liability. Those are minus pluses. And we have R for revenues. And there's a minus plus. Okay? So, DEAs are plus minuses. CLR are minus pluses. One of the rules said that debit is always on the left-hand side of the T table. So this is the left-hand side. So this is a D for debit. 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 D for debit. And D for debit. Okay? So notice that these three are increases to the debit side, and these three are decreases to the debit side. Meaning that if the value was 0 on this side, as one of these three, if we want to make it 5,000, we have to do the plus side, because this is increase. If the value is 5,000, and we want to make it a 4,000, we're going to do a decrease on the credit side of $1,000. Okay? Opposite goes for these. So the debit can be an increase or a decrease.
Okay, so you know how you just gave the example of there for if you have 5,000. So I don't understand the debit decrease.
So let's say that this asset was supplies. Right? The offset to supplies is supplies expense.
Oh, if you got 509 and then you spend 50, like you said,
So my balance, I bought supplies, I bought 500,000 for each. So we had $5,000 of supplies, meaning this was the beginning balance, right? If I buy more supplies, I'm gonna put cash at it, just so we can do a PPE. If I bought more supplies, I'm gonna have $1,000 on this side and $1,000 on this side because I used my cash,
right,
and my cash balance went down. So let's say my beginning balance of cash was $10,000. Now my balance of cash is $9,000. So my debit equals my credit, $1,000. Now, this means that I have a balance of $6,000 of supplies. In the balance of $6,000 supplies. Now, if the end of the month comes and we want to show that we use our supplies, let's say I use $2,000 worth of supplies. Am I going to increase my supplies expense balance or decrease it? You supplies expense.
You're taking it away because if it's an expense, you're paying out. You got to pay for it, right?
You're talking about cash.
Okay, it's expense, so you have to record it what you spent.
You have to record what you use. Not necessarily what you spent, because what if you didn't pay cash for it?
What you utilize. So even though
supplies expense is not directly related to cash. Supplies is. Because you bought the supplies with cash. That has nothing to do whether or not you use the supplies. Using the supplies is a different transaction than buying the supplies. So at the beginning of January, we bought $1,000 more supplies. We paid for it with cash. If we didn't pay cash, we would use AP. So it would be $1,000 over here for AP because AP increased. It would still be $1,000 worth of cash when we got. You just wouldn't have used cash. that transaction, these go together.
So if we use $2,000 worth of supplies,
So now we use $2,000 worth of supplies, meaning that when I write this out and I say, how much do I have in supplies expenses? What are you gonna tell me? You said 2,000, right?
right, yeah.
So you're gonna have supplies expense equals 2,000 bucks. Because that's how much I've used. This has nothing to do with what we take. This is how much of the supplies do we use. So how much of the supplies did we use before this? Okay, so my balance was 0 before.
Right.
What's my new balance?
So,
So am I increasing this account or decreasing this account? Increase. So here's gonna be my $2,000. So where do I show the offset? What account needs to be deducted to show I don't have that anymore because I used $2,000 of it?
credit, I mean, supplies,
It's gonna be a credit. So now my debit equals my credit. And my new balance is what?
are we not putting those together?
This is how much we had.
Right.
This is how much we used.
Right.
So what do I have left?
Before.
I have 4,000. Is it a debit or a credit?
Debit.
It's a debit. We just went through chapters 1, 2, and 3.
Just now?
Yep. Because when we first started chapters 1 and 2, we went over transactional entries, meaning entries that something happened which caused us to create it.
Okay.
We purchased supplies.
Right.
We paid utilities. We
Took out,
we invested money. We took out money. All those are transactional entries. In chapters 3 and 4, we looked at adjusting them, meaning that there was nothing that specifically happened when we did the supplies. We just counted them again and we noticed that we had $2,000 left. Actually, it's not that we noticed. Every month we go back and we count our supplies at the end to figure out, well, how much do we have left so we can make an adjusting entry to show that we've used it. Because we're not, every time we take a pencil or every time we take a pen, we're not deducting it. We wait until the end of the month and we say, hey, this is what we have left, and we do an adjusting entry for it. The next thing we just did was, how do you determine what the balance of the account is? So you take the highest balance, you subtract the lower balance, and you get your balance and you put it on the higher side. So we had $6,000 of supplies. We used $2,000 of it. So we increased it to $6,000. We decreased it by $2,000. So my balance is $4,000. Larger side minus smaller side equals my balance, which stays on the larger side. This is like having little buckets of jelly beans. Let's say each one of these little circles. So this is 5,000 jelly beans. 1, 2, 3, 4, 5, right? We added another $1,000. So we ended up with 6,000 jelly beans. 1, 2, 3, 4, 5, 6. We took away 2 of them. So 1, 2. Now our balance is 4. 1, 2, 3, 4. Make sense? Mm-hmm. All right. So we got our 6 items up here. So we're going to be on page 14. So the first transaction says an investment by owner. On December 1st, Chaz Taylor, he formed his business. He owns and manages the business. He sells footwear and accessories. But I don't actually know what this man does. I don't know what it is. This is a long paragraph. So, either way, This particular transaction says that he invested $30,000 in the business. Mr. Taylor said, hey, I want to start my business. I have $30,000 in my savings. Let's do this. I'm going to put the entire $30,000 in, and I'm going to do this. I'm going to go on a limb. I'm going to start my business. He has to know that there's a difference between what's in his personal bank account and what's in his business bank account. You can't run your business based on your personal assets, because then the business accounting won't be equal. It won't be balanced. So whatever you're going to put into the business, you either put into the business first and then utilize it for the business. So his transaction, his first one, was every transaction needs 2 or more T tables.
I don't think that's ask you, like, how many T tables should you
2 or more. You have a million, but it has to be at least 2, because your debit must equal your credit.
Right.
Now, could it be 2 assets? Yes.
No.
You can have cash and supplies.
Oh,
Those are both 2 assets.
Okay, you can have like accounts receivable
And supplies.
and supplies.
Accounts receivable and building.
Accounts receivable.
No, I'm sorry, I'm lying. You can't have AR and supplies, because AR is money people owe us. But you can have cash.
As an asset. Remember, you were giving us the examples of building, computer, and it's also known as accounts receivable.
Yes. So accounts receivable is the value of what somebody owes us. So if they owe us, it's not with supplies. Accounts payable is with supplies, but cash can be with supplies.
Yeah.
Because you can use your cash, which is an asset, to buy supplies, which is an asset. So you can exchange those types of assets. You basically say, hey, I'll give you cash, you give me supplies, both assets.
Sorry, I picked you up.
No, that's not a fact. Somebody else probably has the same question. So if we have an investment into the business, those 2 T tables is going to be whatever he invested. So if they would have said he invested a $30,000 building, then this would say building. Okay? If he invested computers, then this would say computers. Okay? In this particular situation, he invested cash. Right? So, if he invested cash into the business, we must recognize that we also have an account that shows investment. That account is capital. Remember? Drawing shows what we took out. Capital shows what we put in as an owner of a company. So my other account is going to be capital. You can just memorize that. Okay? So once we know what accounts are impacted, we then have to look at, is it a plus minus or a minus plus? So is it an asset? Is it expense, drawing, capital, liabilities, or revenue? All right? So cash is an asset. Capital is capital. Okay?
I'm sorry. Okay. So this is where I also get confused. So can't drawing be cash?
It could be the offset for drawing.
Okay.
So if you withdraw something for the business, you withdraw cash. So if we have 2 T tables, one is going to be drawing to represent the value of what you took out the business. And then the offset is going to be cash to represent that you took out cash. But what if you didn't take out cash? What if you took the computer? It will be computers and drawing.
Okay.
Drawing is not always, it usually is, but it's not always necessarily cash.
Okay.
So, cash is an asset. Here are my assets. Assets are plus minus. Capital is capital. Capital is minus plus. Always know where your debits and credits are, and they're always going to be in the same place. Left hand side, debit. Right hand side is capital. I'm sorry, it's credit. Now, the transaction said that he invested $30,000 into the business. You gotta ask yourself, what happens to my cash account? Did it go up or did it go down?
Yeah.
Do we have any cash in the business before?
Yeah.
Oh, because it's not his personal
Yeah.
journal entry. This is his business journal entry. So his cash balance in the business went up to $30,000. So we're gonna increase by 30,000. So let's talk about his capital account. All right. So he put in $30,000 into the business. So inside of this business, what was his capital account before he put any money into it? Because this word, this line item, this item represents how much the value of what the owner put into the business. It is an ongoing account. You're going to keep track of it all year long, because if he uses the whole $30,000, he might want to invest more. Well, what's the best way for him to track and to show how much he's put into the business? Is with this capital account. So what was the beginning balance of the capital account? And then what is the balance of it now? So it went up or down? How much is his debit? How much is his credit? His debit equal his credit. Throwing into one. Okay.
Real quick, sorry. Besides the debit and credit always being where it's supposed to be, really what we're paying attention to is the plus minus. For real.
Yep. But if you memorize them, put them down. You don't even got to have it written down next to you. You don't even got to memorize.
Yeah.
Have it written down. What you have to memorize is what category they go into. So, what goes first in the journal entry? Debit or credit? Yep. Journal entries, debit goes first. So my debit is going to be what? For which category? Yep. So cash as a debit of 30,000. And then what's my debit? Capital. I'm sorry. Sorry. 30,000. Capital of 30,000. What day did they tell us it was happening? No, I'm breaking the water fountain. Don't break the water fountain, man. Coffee in here because it's cold and it's cold enough. 12:1. So when you do this on the problem, it asks, you have to attach your journal entry by date. Make sense? The second transaction says that he purchased supplies for cash. Notice that they tell you how is he purchasing it. Because if it says on credit, that means he didn't give up any cash.
Right.
So he had to use accounts payable because he's going to owe somebody for those supplies later. So our date is going to be They didn't give us a date.
So with the 2 T tables be cash and supply?
Yep. Cash and supply was perfect. I don't have a date for this. They stopped giving us dates. We're going to use December 2nd. 12/2. Definitely For number two, so you said cash and supplies? I definitely agree. Why? Because we use our cash to purchase supplies. Okay. So is cash a plus minus or a minus plus?
Cash is a plus.
Because it's an asset. All assets are plus minus. Is supplies a plus minus or a minus plus?
It's an asset.
It is an asset. That does not say supplies expense. It just says supplies. So supplies is an asset. So it is also a plus minus, which means that you're allowed to have two plus minuses or two assets.
I don't know because it's, I guess it can still balance it.
It does because supplies is going to go up, but cash is going to go down. That's why it's okay.
Right?
Does my debit or credit do anything weird?
No.
No. Debit is always going to be on the left hand side, credit is always going to be on the right hand side. Okay? So how much did we utilize? Or how much did you buy? 2,500. Okay. So how much cash do I have? I'm going to put the balance of cash on here just so we can see that this is the same as this. Does that make sense? This cash is the same as this cash.
Right.
So our beginning balance,
Oh, so you just basically.
I'm gonna just bring it down.
Yeah.
Yep. Our beginning balance is $30,000.
Right. Right.
We use 2,500 of it. So am I gonna increase this balance or decrease this balance? Decrease it. So $2,500. And then what's the balance of my account gonna be calculated? Oh, there you go. 27.5. Is it gonna go on the debit side or the credit side?
It's gonna go to debit.
So my balance is 27,500. This is how much cash I have after this transaction.
Right.
Okay? How much do I have in supplies?
25.
I have 2,500. How much did I have before? None, because I haven't bought it yet. This is me just starting my business. Now I'm trying to figure out what I'm doing. So my supplies go up or go down? Goes up. So I'm gonna put 2,500 on the debit side. My debit here equals my credit here. Okay? What's my balance in supplies? 2,500 on the debit side. How do I create my journal entry?
Boom. So you put cash. You do 12,
I do 12-2.
you do cash.
I'm doing my debit first. So remember, this is the balance. These two are the transactions.
Right.
So which one is my debit?
So you talking about the amount, right? Or
Which one do I have a debit for these transactions?
it's the cash.
Nope. Cash to credit.
Oh. Supply.
Yep. So supplies,
Is it 25?
2,500. And then cash is my credit. See, supplies is a debit, cash is a credit.
Is it gonna be the 27,500?
It's gonna be 2,500. This is not the balance, this is just the transaction.
Oh.
So when you create a journal entry, this is for your own personal use.
Okay.
This is what you put on your books. The journal entry is a better representation of your T tables, because you can't send somebody a piece of paper with a bunch of T tables, because it look crazy. But what you can do is send them the journal entry.
I got a question.
Yep.
Well, why not put what the balance is in the journal entry so you can see, you know what I'm saying? Like step by step, that equal that.
Have an answer. So in accounting, Each one of the reports that we use give you the same data in a certain format. Okay? A T table can show you the transaction plus the balance in the account. Okay. A journal entry just shows you, okay, T table equals the entry plus the balance.
Yes.
A journal entry just shows you the entry.
Yeah, the entry.
A trial balance just shows you the balance.
So it's a whole system.
It's a whole system. So the financial statement, well, the P&L or the income statement just shows you your revenues and expenses.
Okay.
The balance sheet
Yeah, the balance sheet.
just shows you your assets and liabilities. You know my writing starts to it starts to go down once I start writing a bunch.
This helps so much because in the word problems,
I think they introduced the trial balance in chapter 2, maybe 2 or 3. You have the statement of owner's equity. That just shows you your capital in your drawing. And the total profit, which is the revenue minus expense. I'm gonna change this from total profit to net income, because that's what we're having. Statement of owner's equity, that's another one of the reports. And then you got a statement of cash flows, but that don't have the money stuff on it. Makes sense? So presentation is the only thing that changes this data. But all of this will come from the data. The journal entry helps you to put it in place. Okay. If you look at the trial balance, you're trying to figure out, well, what happened? How did it become this number? You're gonna go into the system, you're gonna pull up all the journal entries. You're gonna look at all the journal entries that says whatever the account number you're looking for. So if you're looking for cash, trying to figure out where your cash is, you're gonna look at all your journal entries. You look at the cash entries. You go into the specific journal entry, oh, we paid $2,500 for supplies. That's where my cash went down.
Right, okay.
Okay? All right, the next transaction is the purchase equipment for cash. So what are my transactions, or what are my accounts being impacted?
Actually, so the book assets.
They're both assets, so we're gonna have cash, that's one. What's my other one?
Equipment.
Equipment. Yep.
And they both split plus minus.
They're both plus minuses because both of them are assets. Okay. My debit is always on the left, my credit is always on the right. So, my beginning balance of cash is how much? 27,500. My beginning balance of equipment is 0 because I haven't purchased anything yet. So what happened with my cash? Did it go up or go down?
Mm-hmm.
By how much? $26,000. Lord Jesus, I ain't got that much money left. All right. So is it going to be a credit or a debit?
Credit.
It's going to be a credit because cash is going to go down. If this represents a positive balance of cash, I have to go down in order to take it away. So you said 26,000. What's my balance?
51.
Am I going to put it on the debit or the credit side? Debit side. Because this is a bigger balance. So you had 27,500. You subtracted 27,000, so I still have 1,500. What happens to my equipment? Does the balance go up or go down? Nope. Went up, so I'm going to do a debit, $26,000. So my debit equals my credit still. Right? What's my balance in equipment? 26,000 as a debit. Journal entry, what goes first? The debit or the credit?
Debit.
Which one is my debit?
Debit is the equipment.
It is. You just said that. And that's 26,000. Remember to indent your credit. So we have cash and 26,000. If we would align all of these journal entries up together, we have credit, credit, credit. They're gonna all be lined up. The debits will be over in their own column. So credit, debit, 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 credit, credit, credit. Okay? You ain't got no money. Transaction 4, purchase supplies on credit. Now, why do we have to purchase our supplies on credit?
You got it.
We don't have no money.
You got it.
We ain't got it.
You got no money.
We ain't got no money. So we purchased $7,100 in supplies. That's a lot of supplies. But he hasn't purchased anything for his office yet, so kind of makes sense, right? All right. So the key here is trying to figure out, well, what are my T tables impacted? I'm going to use these my attention.
Can you write to that?
So what are my accounts impacted? Supplies and AP because you owe somebody, right? Supplies is what type of an account? An asset. And what about AP? What type of account is it? Liability. So supplies Is it a plus minus or a minus plus? It is still a plus minus. What about AP? Is it a plus minus or minus plus? It is a minus plus because liabilities and all liabilities are minus plus. Right? So then we ask ourselves, well, first I'm going to keep the balance up there. So the last transaction we had for supplies was this 2,500. So right now, our beginning balance is $2,500. Right? Our beginning balance of AP is 0 because we don't owe anybody any money yet. Now this transaction is happening, and now we have to make some changes. So how much did we buy in supplies? $7,100. So does my supply balance, how much I have in supplies, go up or go down? Goes up. So we had 2,500. We purchased an additional 7,100. So what's my balance in supplies now? $9,600 in supplies. How much do we owe people? So how much did I owe before? 0. So how do I make it so that it shows that I owe $7,100 instead of 0? I put it on the plus side. This is the debit, this is the credit. So the plus side for this one just happens to be a credit, which does not mean plus or minus or increase or decrease. Credit means right side of the T table. The debits and the credits help all the transactions stay equal, stay balanced. So we're going to put the 7,100 over here. My balance is going to be 7,100. Okay, I just need a whole new way to write 7,100. All right. So if that's the case, are my debits and my credits equal? What was my debit in this transaction? It's just this transaction. Each transaction, my debit must equal my credit.
It don't, because it's like 25.
No, that's just the balance.
Okay.
This is the transaction, and then this is the other transaction. Yep. So my debit equals my credit. Debit equals my credit. So the transaction is still balanced. And as long as my debit equals my credit, then my journal entries are going to always agree. So what is my debit so I can create my journal entry? It is.
It's surprising because debit's always go first.
Yep. And there's my journal entry. Got it?
I can do the problem with myself.
You can be able to do them by yourself now. Yeah. All right, next transaction. No, I'm going to pause this for a second, and then I'm going to let you take a break. If you guys are following this recording, what I want you to do now is work on 5, 6, 7, and 8. So that's going to be on page 15 and 16. So pause the assignment, and then when you come back, we'll go over 5, 6, 7, 8. But go ahead and work on it yourself. All right. So number 5 says we provided services for cash. So the transaction first says we provided consulting services to a power walking club and immediately collected $4,200 cash. So they have chosen consulting as the T table. So number 5, yep. If you didn't use consulting, it's okay.
Accounts evolved. It says cash and revenue.
Yeah, revenue is a type of, consulting is a type of revenue.
Oh, okay. Well, I just put revenue.
That's fine. And then the other one was cash because we took the cash in. It's an asset. All right, so consulting, since it's a revenue, is a minus plus. Cash is an asset, is a plus minus. Our debits and credits is still in the same place. Consulting went up or down by $4,200. Cash went up or down by $4,200. Is our credit and debit equal? Yes. So our balance in consulting is $4,200. I'm sorry. What was our beginning balance of cash? So we're gonna pull our beginning balance of cash from here. So 1,500 beginning balance. So we added 4,200. So what's our cash? $5,700. Journal entry. What goes first on the journal entry? Debit. So cash and consulting. So we have 4,200 here. 4,200 here. Bam. All right. And then number 6 says we're gonna pay payment of expenses in cash. So we're gonna pay 2 different types of expenses. One is gonna be rental expense. So we're gonna do 6. So we have cash, right? And our second T table is going to be rent expense. All right. Cash is an asset, so it's plus minus. Rent expense is an expense, so it's plus minus as well. Put our debits and credits down. Does rent expense go up or down? Yes, because we want to show that we spent $1,000 on rent. Balance is going to be $1,000. So that is the total amount that we spent on rent so far. Cash, we had a beginning balance of $5,700. Now, does cash go up or go down? It goes down because we want to spend $1,000. So we're going to put the $1,000 on the credit side because that's where we represent going down. What's my balance? $4,700. Yep, $4,700. Does it go on my debit side or my credit side? Debit side. Still a debit balance. We subtracted it from what it was before by $1,000. Then my journal entry, debit goes first, which is rent expense.
So real quick before we go further, are we not adding in the salary expense?
Yep, that's number 7. Yep, I'm gonna do that as well. So this journal entry, actually you could,
Because I did it all together.
you can. Let's do that. We're gonna add our third T table. Salary expense. Salary expense is also an expense. Expenses are plus minuses. Plus minus. So how much do we want to show that we had in salary expense? $700.
Wait, I thought it was in.
So then how much did we use in cash? 700. So this is a journal entry, and this is a net journal entry. This is a net journal entry, and this is a net journal entry. So what's the total of my debit? And show me where they are.
The total is 1,700.
Yep, so 700 from salary expense is the debit. And 700 from rent, 1,000 from rent expense, so that's 1,700 in the debit. So rent expense is one of them, and I'm gonna put salary up here. So I can have enough room. Salary expense is the other one. I'm just gonna move this down and up a little bit so it doesn't. Alright, so salary expense is 700 as a debit. Rent expense is 1,000 as a debit. So debit equals 1,700. My expense is gonna be cash. And I have this 1,000 and this 700. So that's 1,700 for cash. My debits equal my credits. So that's my journal entry, but what's my balance in cash? It's gonna be 4,000 total. So we minus 1,000 and subtract the 700.
But that doesn't even go on the
That's gonna drop. We did, not the balance, but the transactions.
So when I just thought about that, I shouldn't have used it, put the both the expenses together in the journal entry.
You can, I did too. No, not on one line.
That's what I'm saying. I did the 1,700. You gotta break it
If
down
you
to
had just
700.
titled it expenses, you
Right.
could have.
Okay.
But we wanna see how much do we have in salary,
Right.
how much do we have in rent. So we're gonna put both of them in separately. So this is 6 and 7. All right, and then number 8 is going to be provided services and facilities for credit. Okay, so what that means is we performed a service, but they did not have any money. They didn't have any cash. So since they didn't have any cash, we applied it to our accounts receivable balance, which represents the dollar amount that people owe to us. So this is going to be number 8. So we did services 2 times. So these are going to represent our different types of services. And the last one is going to represent how we receive payment, which is going to be AR because we haven't got it yet. AR is a plus minus because it's an asset. These are expenses. I wonder if this is going to show backwards for them. It looks like it. Looks crazy. All right. So,
So for the two other tables, this is consulting.
yep, it looks okay. So consulting and rental. All right. So consulting and rental. Are these plus minuses or minus pluses?
It's minus plus.
These are minus pluses because they are forms of revenue. Okay. Remember, debit always on the left, credit is always on the right. How much did we make in consulting revenue? So we did have some consulting revenue before.
Oh,
We have 4,200. No, this I'm going into it. So 4,200 is my balance. So I'm gonna put 4,200 over here. That's my beginning balance. Okay, so how much did we make this time? 1,600. Is it a minus or plus? Is it increase or decrease? Increase. So 1,600. And we had no rental,
or no, not prior. No.
we had no prior rental expenses. The balance is still 0. And then what was our new? 300. And then how much do they owe us? Okay, am I gonna,
Together, right?
Yep.
Yes, together.
am I gonna do an increase or decrease? Increase from 1,900. So my credit is 16 plus 3. My debit is 1,900. So that's debit equal credit. Journal entry. What goes first?
Debit.
Debit. Okay. We have AR of 1,900. What's my next one?
Social revenue.
Consulting, 1,600, and rental of 300. And then it's equal my 30. That's what I'm on. Okay, that was 8, and then 9. Nine is going to be receipt of cash from accounts receivable. All right, so now they are paying us from our previous accounts receivable. So 9. So we're gonna have our journal entry. Erase a little bit of this. AR, and then what's the other one? Because that's how they pay us. All right, AR,
Plus one.
because it's an asset, because it's an asset. So what was our beginning balance of AR? 1,900. What was our beginning balance of cash?
44 plus.
All right. So what's going on with this transaction? They are paying us the 1,900 they owe us.
So that means that so receivable.
Yes. Is it an increase or a decrease? Am I going? So I'm going to put another 1,900 here.
Oh no.
Yeah.
If it's received, we're getting that money.
We are getting that money. So if we're getting the money, what happens to our AR balance that shows us how much people owe us? If
No.
Think about it. So our balance in AR is $1,900.
Right.
1,900 represents how much somebody owes us. So if they make a payment, do they still owe us $1,900?
No.
So then how do we show that our AR balance is no longer 1,900? We're going to go down. We're going to decrease it by 1,900 because now what's my balance in AR?
Nothing, because they paid.
0.
Boom.
And then what happened to our cash? It went up by 1,900
Right.
because they gave us 1,900. So instead of having $4,000 in our cash account, does that mean we have now another 1,900? Our cash balance is going to be $5,900. What's my debit?
$5,900.
Oh, what's my debit?
$19.
And what's my credit?
Oh, $19.
So my debit equal my credit.
Yeah.
So we're gonna have cash of 1,900 and credit AR for the same amount. We only have one more entry, so we're gonna do that before we leave, and we can do that in 4 minutes. Oh, we got 2 more. Okay, we're still gonna do both of them. So number 10, we owed somebody some money before. We're right here. We owe them this money. Oh no, we paid it. So what are we paying? Because I feel like we don't owe anybody else. From transaction 4. Oh, okay. We didn't pay them. This is the journal entry. Okay, so we owe them 7,100 back then. for that, for those supplies, because remember at that time, we only had $1,500 cash,
Yeah.
so we owed them for those supplies, we were paying them. So now, basically, we're paying them. So, number 10. Does my supply balance change because I'm paying cash?
Mhm.
Nope. But we know cash changes, right?
Right.
What's my other account that changes?
I mean, it's not fair.
It is, because now we have to show that we don't owe them that money anymore. Cash is a plus minus because it's an asset. AP is a liability, so it's minus plus. Beginning balance of cash is here, so it's 5,900. The beginning balance of AP
It's 71.
is 7,100, so that's how much we owe people. And they're telling us that we're paying how much? That's all? Man, we stingy. A partial payment. Partial payment of that? Oh, okay.
Yeah.
All right. So, we're gonna decrease our cash,
Yeah.
we're paying it. And then we're going to increase or decrease our AP. So we owe 7,100. So if I do an increase, it's gonna go up.
Right.
And we don't wanna show we owe more because we actually don't owe more, we owe less. So, gonna decrease it. And guess what? Now my credit or my debit on that transaction. So my entry is gonna be debit first. So AP is my debit of 900. And then my credit is gonna be cash of 900. Oh. Number 11, final one, is gonna be withdrawal of cash by owner. He was like, oh, wait, I got a little bit of money.
A little bit.
Let me go ahead and take some of that out. Oh, what's my balance in cash? $5,000. So he's gonna take some money out. So if he's gonna take some money out, our key table is gonna be cash and drawing, right? Taking money out of the business, and drawing is the name of the account that represents that. Drawing is a plus minus. Cash is a plus minus because it's an asset. How much is he taking out? So he's gonna take out $200. Does cash go up or go down? Down. Oh, we're not gonna do down. Our beginning balance comes from here. $5,000. No, don't try. Sorry. We got $5,000. So I'm gonna take it down by 200. So my new balance is gonna be how much?
5,000. I mean, 40.
4,800. Yep. For $4,800, my new balance, because I'm taking out 200. And my drawing account, the previous balance was 0 because I had never withdrew any money out of the account. But since I want to show that I withdrew money out of the account, I want to put $200. It's going to go in an increase account because my balance, I know. So I withdrew the cash. That's the decrease. But drawing, so this shows what my balance is in cash. The same way that this shows what my balance is in drawing. It doesn't mean I withdrew, so I do negative.
Not literally.
Not literally. It just, this name just says, hey, if I look at your financial statements, how can I tell how much money you took out for personal use? They're gonna say, oh, well, look at my drawing account. And my drawing account is gonna show a balance of $200, which is gonna mean I took out $200 on this drawing account. This is the same concept as AP. Because do we know that AP is a decrease of cash? Yes, we do. But that's not the point of the T table. It's to show how much have we taken out. How much have we taken out? Not how much have we paid? No, sorry. How much do we owe? AP shows how much do we owe. Drawing shows how much do we take out.
That's just one of the things you're supposed to know.
You just have to know.
Okay.
AR shows how much people owe us. AR shows how much do people owe us. AP shows how much do we owe. Capital shows how much did I put in. Drawing shows how much did I take out. The only time we're going to do negative, actually there's no negative for drawing.
Right.
The same way there's no negative for capital.
Right.
The negative for capital is drawing.
Really?
The offset to capital is drawing.
Yeah.
You'll never have a credit unless there's a mistake. You have to fix it because you made a mistake. Like say you thought you put in 10,500, but you really only put in 10,000. You'll have to decrease it by 500 so you can get your other balance correct. Okay, so all the summary of those transactions are on page 17. And then on page 19, they took all those transactions and they created the statements. So although we did the problem out of chapter 1, this is actually chapter 1 and 2, because we went over the problem, we went over the T tables, and we went over the journal entry. This is your baby. That's a big baby. This is a big baby. This is 2 weeks worth of work.
I like that way better. I'm saying the first one is bad.
I think repetition is it helps it.
It definitely.
So that's chapter 1, and if you look at chapter 2, you'll show those T tables. And then chapter 2 also shows, I actually don't see the journal entries. Maybe that's chapter, yep, and chapter 2 also has the journal entry. So anybody who is looking at this will get points. Send me an email or a text message to 513-903-2038. Let me know your first and last name, and I will give you 10 points. In addition to that, you are more than welcome to go back and redo the assignments for chapters 1 and 2. Send me an email, let me know you did it, and that way I can sync it again so you can get your points for chapter 1 and 2. And if you want to go back and redo some homework assignments, you're more than welcome to do so. They are all still open. Just let me know.